Hi, this is the second in our set of three notes that are dealing with the broad topic of investment. And what this best fits under is the topic of open economy macroeconomics. So, in the economics department, we actually have a course that's called Open Economy Macroeconomics. And in that course, you deal with some of the things that we're talking about today, as well as exchange rate determination. Um, International monetary organizations, the relationship between trade and financial flows, other kinds of things. So if you were interested in that, that course is Econ 435. So you could certainly look for it in your future career in economics. What we're going to be doing today is to principally focus on this idea of net financial capital inflows. And I want to begin by saying I think these notes are really, really hard. And I don't know of any way to make sense of them apart from just practicing writing. I mean, when I was learning this stuff, again, I'm pretty old school, but I wrote the definitions out. I played around with some made up numbers. I quizzed myself over and over and over again. And even so, even now, when I get to the end of this set of notes, I feel like my head's going to explode. So if I feel that way, I certainly understand that you do, or that you might. And I just want to stress that it'll come, but that it's not going to come without some effort. So, what we're going to do is talk a little bit about what we mean by a financial system. So, that'll be part of the overview notes. And then we will define and explain what we mean by capital inflows and net capital inflows. We will then try to accomplish four things. And the four things will have their impacts later on as the semester goes on. So we're going to link this idea of net financial capital inflows to net exports. We will link real interest rates and net exports. We will link the idea of net capital inflows to the broader idea of savings. And then we will talk briefly about this kind of important question of are trade deficits in a pejorative sense bad? So, in order to set the stage for this, what I think is important to do is sort of go back and outside of the course a little bit and think about what a financial system is. So, to put this in context, again, remember that we said that when we depicted the macroeconomy as a circular flow, we had four big macroeconomic agents: households, firms, the government, and the rest of the world interacting in four big macroeconomic markets: the market for final goods and services, the market for inputs, the market for, or the foreign exchange market, and the financial markets. And so the foreign exchange market will be something that we take up in the next class. The market for inputs, we talked about in a big way in the investment notes and the preceding notes, but it sort of transcends into these. And at this point, we're going to introduce what we mean by financial markets, and we'll see other examples of financial markets as we go. But when we think, first of all, about the financial system itself is a network of markets and institutions, or another word for institutions is intermediaries, that does two things. So it brings together savers and borrowers in an economy, and it provides financial services. So the financial services can include risk sharing and diversification, the provision of liquidity, meaning taking an asset that, like a house, that can't be readily converted into sort of a more liquid asset would be cash, and it provides information. So in a finance class, you'll take this up, or in say a course like Econ 3311, which is financial markets and institutions. You'll take up these kinds of these kinds of issues more carefully. What I want to emphasize at this point is that what the financial system does is it transfers funds from savers to borrowers. And the mechanism by which this happens is to create, if you want to think about it, what I want to do is try to suggest simple minded ways of thinking about what we're talking about. So we can think about just a piece of paper that is a promise between the savers and the borrowers, or an IOU. And these IOUs, in fancy pants words, are financial assets or securities. So when a borrower borrows funds, that borrower gets the funds and typically in exchange issues some sort of a contractual promise to repay the funds with interest or dividends if we're going to talk about stocks. But the basic idea is that contractual promise we could think of as, in some sense, an IOU, or if we think about the word bond, a bond itself is a promise. And so that's what we're thinking about in this context. So financial assets include literally bonds, stocks, checking account deposits, and a whole bunch of other things that we won't worry about so much right now. And if it's easiest for you to think about this, you can think about savers and borrowers interacting in these in the financial system, and that what's being traded between them is just a piece of paper that says, "I, the borrower, promise to pay you, the lender, some amount of money for the privilege of borrowing today." That's what we're talking about when we talk about a bond or a stock or really any other kind of financial asset. So the financial system, again, is a network of markets and institutions that bring together borrowers and lenders. So we're not going to spend so much time right now talking about financial institutions. We will see this come up a little bit later on in chapter 22 when we talk about banks. But financial institutions, or a synonym for institutions, is intermediaries. So financial institutions act as a go-between, or an intermediary between borrowers and lenders, to facilitate that transaction of borrowing and lending. So we can think about intermediaries essentially as being a box. So they are like this box, a bank, and lenders, who are savers and depositors, are going to bring their funds into the bank, and the bank will accumulate all of those funds and then extend that as a loan to the investors. So, importantly, when we're talking about financial institutions or intermediaries, the lenders and the borrowers, so the savers are also the lenders, and the investors are also the borrowers. These two individuals don't meet, or these two groups of individuals do not meet directly. They transact through the intermediary. In contrast to that, we can think about financial markets. So financial markets bring borrowers and demanders together directly. And so we might put directly in quotation marks here, in the sense that if we're thinking about market interactions, I mean, few of us are going to transact in things that we would think of as the financial markets, where we're actually meeting one another. So some of you might go on to be traders on the New York Stock Exchange. In that particular case, then you are meeting a potential borrower or seller. But we can think about this direct interaction sort of in that spirit. So when we're talking about financial markets can be primary or secondary markets. So a primary market is one in which we have an initial offering. So when we think about literally an IPO, an initial public offering of a private firm stock, that would be a transaction happening on the primary market. The secondary market is where previously issued stocks or bonds are subsequently traded and retraded. So the New York Stock Exchange, for instance, would be an example of a secondary market. And there are secondary markets, obviously, for stocks, but there are also secondary markets for debt. You will spend a lot more time learning about these things in other classes. So, in particular, in a class like Fin 340 or Econ 335, which is money and banking, offered in the spring semester, you'll learn that markets differ in the maturity of the assets that are being traded. So, the maturity means literally at how long does it take for the financial asset to be redeemed. And so money markets are ones in which the nature of the asset that's being traded are short term assets, and capital markets, which is going to be our focus principally today and in the subsequent set of slides, are ones in which the financial asset that's being traded are have a maturity that is longer, decades maybe, or longer than that. Markets are going to differ in the type of trading. So they can be auction markets, over the counter markets, for example. So, again, in other classes, you'll take up that difference more specifically. And these markets can differ in their settlement structure. So it can be one in which buyers and sellers meet and engage in a transaction where a financial asset is traded immediately for cash. Alternatively, it can be a situation in which we have a derivative, so a promise to either buy or sell a financial asset at some point in the future. What we're going to be talking about in our examples over this set of this set of notes provides the foundation for the next one, which is a discussion of the loanable funds market. So one example of a capital market is a loanable funds market, where we're talking about demanders and suppliers of savings meeting together. The nature of the asset that's being traded is long term because the savings are being demanded by borrowers who we think of in this context as undertaking investment. And as we saw in the previous set of notes, when we think about investment, we're talking about the purchase of a capital asset whose life is very long, like a house or a building or even a machine. So again, I'm going to try to hammer this as we go through the remainder of the notes, but remember that on the demand side, the borrower of funds is receiving the funds but selling a promise to pay those funds in the future. And that IOU, or that promise, you can think of as being a bond. The borrowers are undertaking investment. The lenders who are giving the funds temporarily to the borrowers are savers. So they are saving in the macroeconomy. And the price in the marketplace is going to be an interest rate. And specifically, we're going to think about it as a real interest rate. So, what I want to do to get at a piece of the loanable funds market. So, there are many purposes to this set of notes, but one of the purposes is to explain a piece of the loanable funds market. And in order to do that, it seems to me that we need to explain a little bit more carefully the relationship between the domestic and the international economies. And so the domestic and the international economies are going to be linked via trade. So, trade in what? Trade in goods and services. And we already talked about this in the context of net exports, and trade in financial assets. And so, what do we mean by financial assets? Again, this could be stocks or bonds. So, again, promises to pay in the future, some IOU that are issued by the private market participants. In the US, this could involve government securities. So these are in the US known as US Treasury securities. It is the Treasury Department in the United States that issues these IOUs, or these promises to pay. And these are fall into several categories. They are Treasury bills, Treasury bonds, Treasury notes. So not relevant at all for what we're going to be doing in the future, but these different assets differ in their term to maturity. So Treasury bills involve assets whose that you could buy and then redeem them in as little as a month, 4 weeks, or in as much as a year. A treasury note is one whose term to maturity is between 2 and 10 years, and a treasury bond is one for which the term to maturity is more than 30 years. For those of you who are studying or anticipating studying finance, these are things that we think of as being fixed income securities or fixed income financial assets. And by fixed income, what we mean is that there is a regular payment of interest and then principal at the end of the loan contract. So it's fixed income in the sense that that interest payment is predictable and regular. What I think is useful to do is to simplify as much as possible in what we're going to be considering in the future. And so one way of simplifying again is to think about, appealing back to the circular flow idea that firms are the demanders of funds or the borrowers of funds who are undertaking this for investment purposes, and they are going to borrow funds and issue or sell an IOU like a bond. Savers are the lenders in the economy, and when they lend to the borrowers, they in turn acquire this piece of paper that says they're going to be paid back some amount at some point in the future. So the other category of trade in financial assets is real assets like trade in land, buildings, etc. And this is in fact the focus of your project. So I'm asking, would you undertake foreign direct investment? So something that is more permanent than just buying or selling a financial asset that you could then turn around and buy and if you bought it, you could turn around and sell it in a short period of time. I want you to consider for your country the question of whether you're in it to win it, so to speak. So, what I think is helpful in here is in the course of what we're going to do is to pick a country that is your perspective. So, by virtue of the fact that I'm a US citizen, I'm going to take the perspective of the United States being a domestic economy. So I'll probably I'll try, flip, more or less from your perspective, probably at random between saying the US and the domestic economy. But we're going to think about the United States, or I think about the United States as the domestic economy that's trading with the rest of the world. So ROW is rest of world. And again, what can those trades be in? They can be trades in goods and services, or they can be trade in financial assets. What I want to do at this point now is focus on the latter. So trade in financial assets take the form of say, the domestic economy. This would be the US as the domestic economy, would be experiencing or having capital inflows when there are purchases of the domestic economy's stocks and bonds, its government securities, or real assets. So, if it's even easier to think about it this way, you could think about this capital inflow, even though it's not technically from an econ point of view as being correct. You could think about this capital inflow as being money. Money is flowing into the United States as a result of somebody in the United States, either a private company selling its stocks or bonds to somebody in the rest of the world, or the US government selling its treasury securities to someone in the rest of the world, or another government indeed, or somebody in the US selling their land or buildings to someone in the rest of the world. Similarly, because trade is a two-way flow, there can be capital outflows from the United States. And again, if it helps, think about capital outflows as being money. Again, it's in an econ, you know, true definitions in economics. It's not just strictly money, but that's good enough. So we can think about money flowing from the United States to the rest of the world as a result of the United States buying, say, shares of Daimler Chrysler, a German company, or shares debt obligations of the French government, or undertaking foreign direct investment in Botswana. Those would all be examples in which money would be flowing out of the United States, and in exchange, the United States would be getting some sort of financial asset, a promise of repayment in the future. So, with that, we come to the beginnings of some hardcore definitions. So, if your head isn't already spinning, here we go. Um, when we think about exports and imports of goods and services, we didn't focus on just one or the other. We looked at net exports. So, in a similar fashion, what we want to focus on is the net of these flows of financial capital or money, if you will, into and out of the domestic economy. And so I have a bit of a conundrum in the sense that these are the perils of a first edition book, in my opinion. In chapter 16, which you are not required to read, but if you wanted to read it, you could. The concept that I'm going to be talking about is being described there as a financial, is loosely, is being described as a financial account surplus. And in chapter 14, which I am expecting that you're reading, the authors of the textbook are calling this net financial inflows. So, what I'm going to do is punt on both of those, and so that I can get some notation that is perhaps consistent to what you would see in another course if you were to take an advanced macro class, or perhaps a related kind of financial economics class. I'm going to call this term net financial capital inflows KI. So KI is definitely involving a net transaction. And again, what we can think of this as is on net is money flowing into or out of the economy. So, of course, money is flowing out of the economy when the domestic economy is buying financial assets in the rest of the world. Money is flowing into the economy when the rest of the world is buying the domestic economy's financial assets. And we want to consider the balance of those two. So therefore, capital inflows, net capital inflows, can be either positive or negative, or they could, in fact, be zero. I didn't write that in, but I guess that's also possible. Not, I guess it is also possible for them to be zero. So what do we mean by this? If capital inflows, if net capital inflows are positive, then what this means is that the financial capital inflows, and again, we can think of this if you want as money, to the domestic economy are bigger than the outflows from the domestic economy to the rest of the world. And similarly, if we had net capital inflows being negative, it would mean that financial capital inflows to the domestic economy are smaller than the financial capital outflows. So, from my point of view, all of these words kind of start to blend together. So, let me again try to put some context on this. So, if I can get to my little screen, which maybe I can, maybe I can't. When we are thinking about capital inflows, so capital in net, so again, this is net capital inflows, and if it helps, you can think about this as on net is money flowing into or out of the economy. Capital inflows are going to be a reflection of the domestic economy's exports of financial assets, like stocks and bonds and so forth, minus the domestic economy's imports of financial assets. So again, if we think about this, what is this? This first term means that for the domestic economy, money is flowing in, bonds or IOUs, so I'm just going to write bonds, are flowing out. And when the domestic economy is importing financial assets, it's paying for them. So we can think about that loosely as money flowing out, and bonds or other types of financial assets are flowing in. So again, I think it's really helpful when there are so many mostly unfamiliar words floating around to try to boil it down to its essence. So if it helps to think about just money and bonds, then do that. So if we have net capital inflows that are positive, then what does that mean? That means that the country is on average, oops, shoot, that blows. So if capital inflows are positive, then what that means is that the country is a net exporter of financial assets, right? More, if you go back to what I had written before, more bonds are flowing out than flowing in. And it's also the case that more money is flowing in than flowing out. And so what that means is that the country is a net borrower or a net debtor, in net terms relative to what's yeah, just there's no relative, just is. So again, if it is the case that net capital inflows, say for the US, are positive, that means that the US on net is an exporter of financial assets to the rest of the world. And it means that on net, it's selling more financial assets to the rest of the world than it is buying from the rest of the world. And so, again, by financial asset, you can think bond. And that means that the US is a net borrower from the rest of the world, and similarly, a net debtor. When we have net capital inflows that are negative, that means that the country is a net lender to the rest of the world. So it would just be the opposite sort of reasons that we had both in my handwriting as well as what we have above. And so, from a picture point of view, we have this relationship that there's a certain point at which net capital inflows are zero, and net capital inflows can be positive, or net capital inflows can be negative, so positive, negative, positive. But what we observe is that there is a positive relationship between net capital inflows and real interest rates. So specifically, the higher the domestic real interest rate, the greater the capital inflows. So for instance, so what we have on the horizontal axis is the real interest rate. So if we started at this real interest rate, say R sub 0, and considered R1, we would observe that as the real interest rate goes up, the quantity of net capital inflows moves from 0 to this positive number. I don't know, 10, some number bigger than 0. And this is a key idea for a couple of reasons. One reason is that it's going to tell us something about why the supply of savings in the loanable funds market is upward sloping. And it's also going to help us think about the relationship between the real interest rate and net exports, as we'll see subsequently. So what I want to do first is to think about why there is this positive relationship between the interest rate and the quantity of net capital inflows. So because we're talking about a two-way trade of financial assets, so the US might buy financial assets in the rest of the world, the rest of the world might buy financial assets from the US. We can't just say, suppose domestic interest rates are higher. It's always going to be relative to those in the rest of the world. So suppose it's the case that interest rates in the US rise relative to those in the rest of the world. Then that's going to mean that US interest-bearing financial assets are going to be relatively more attractive because they have a higher rate of return, other things equal. So what would happen? Well, that would mean that we in the US would say, oh, I don't want to buy those foreign interest bearing financial assets, stocks, bonds, whatever, because their return is going to be smaller. And similarly, people in the rest of the world, so this is the rest of the world looking at the US, would say, ooh, I want those US assets because their return is relatively higher. And as a result, what that would mean is that the quantity of net capital inflows would go up. Because again, when we think about net capital inflows, this is, right, so net capital inflows is going to be the domestic economy's exports of financial assets to the rest of the world minus the imports of the same imports of financial assets from the rest of the world, right? So our exports to the rest of the world would be going up. Our imports from the rest of the world would be going down. And so the balance of this would mean that there should be an increase in the quantity of net capital inflows. In other words, we see this curve or line having an upward sloping relationship. And so what we can do with this is, of course, recognize that the opposite is also true, and that is that if there were a decrease in US real interest rates relative to those in the rest of the world, then there would be a smaller quantity of capital inflows to the US. Or more generally, if interest rates in whatever is the domestic economy fall relative to those in the rest of the world, then that domestic economy doesn't look like as good of a deal in terms of interest income. And so there would be a smaller quantity of funds that would be flowing into that domestic economy. Now, all of this is predicated on everything else held fixed. So we're doing the kind of classic discussion in economics, which is to say, let me isolate the effects of one variable, in this case, the real interest rate, on the quantity of net capital inflows, holding fixed everything else. So the everything else would be the shifters of this net capital inflows relationship. So what kinds of things might cause net capital inflows to rise? Well, one of the things might be the relative riskiness of domestic versus foreign assets. If there is either the actual or the perceived reduction of riskiness of domestic assets, then that would encourage greater purchase of them. If there is more purchase of domestic assets relative to foreign, then there's more money flowing in, if you want to think about it that way, and a higher level of net capital inflows. So, in other words, this line would shift out to the right, as I have indicated, from the red to the purple. Similarly, as we've seen time and time again so far, expectations matter. So expectations about what? Well, certainly about relative returns or relative risks. So many of you may find you are studying countries that have experienced speculative attacks. So that doesn't mean that there actually was a change in the relative riskiness, but the expectation that that could happen. So in contrast, when there are more favorable expectations about the domestic economy relative to the foreign economy, then there is a greater interest in purchasing that domestic economy's financial assets. And with that would then be more money flowing in because there would be more of those financial assets flowing out. And then finally, a third kind of big shifter could be demographics and other kinds of factors, say trade related, whatnot. So in the textbook, say on page 361, there's a discussion about how demographic changes where aging populations tend to be, as populations age, they tend to save more, at least for a while. Those savings have to go somewhere. So that could increase, say if there's more savings in Asia, for instance, that could contribute to more net capital inflows into the US. Changes in trade related things, whether it's tariffs, quotas, um, demands for countries' goods, that can generate changes in capital flows as well. So the example that's given in the book is that there was a period where there was greater energy purchase, like oil and gas purchases from countries in the Middle East. Those countries then had the wherewithal to buy more financial assets in the United States, and that led to higher net capital inflows to the US, or this line again shifting from the red to the purple. These are things that we will have recourse to talk about in Chapter 18, as well as in our discussion of the loanable funds market. What I want to do at this point is to take this idea about capital inflows and translate it into the first of our objectives. And our first objective is to try to link this idea of net capital inflows and net exports. And so here's my example. And there's another example in the textbook in chapter 16, which I'm not asking you necessarily to read, but if you wanted to see a different example, you could refer to chapter 16 for that. But here's my example. Suppose you buy $50 worth of coffee from a Costa Rican farmer. Where might you do that? Well, here, this company is selling coffee literally from its farm. And so suppose you bought a bag of coffee, or in this case, many bags of coffee, approximately 5 of them. That farmer would have 50 US dollars. What could it do with those $50? Well, one thing that it could do is just trade the $50 in the foreign exchange market to somebody in another country. So the Costa Rican farmer could get colones, and somebody else would have those US dollars. So that doesn't help us in our discussion of what's to happen, because all it does is just kind of kick the can down the road to form the question for the person who now holds those $50, say somebody in Panama. So, from a practical point of view, if we want to think about the relationship between net capital inflows and net exports, we have to recognize that whoever it is that's holding those 50 US dollars can effectively do one of two things with them. They can purchase $50 worth of US goods, like a tractor for the farm, or services, Netflix. Who doesn't want to Netflix and chill? And so, if it were to buy those, if it were to do that, then it would be a situation in which um, the import of a good, in this case, the coffee, was balanced by the export of a good or service, leaving net exports unchanged. And as we'll see, generating no change to net capital inflows. Now, the alternative, of course, would be that the farmer is holding 50 US dollars and says, yeah, I'm good on tractors. I already have Netflix, don't want Disney, but instead might purchase a financial asset like a treasury bill from the US government or shares in Netflix. Then in that case, we have a transaction that involves the trade in a financial asset. But the thing I think that is important to recognize here is that there's a balance. So the import of $50 of coffee is balanced, and this is really important in terms of thinking about this relationship between net capital inflows and net exports. So it's balanced by one of these two transactions, either the export of a good or service. So my good was, in my example, was a tractor. The service was Netflix. Or it's balanced by a different kind of export, the export of a financial asset. And again, financial asset is just some kind of security. So we said, maybe a treasury bill or shares in a company like Netflix. So what that does is it allows us to then think a little bit more about this relationship between net capital inflows and net exports. And what we have then is that overall, trade has to balance, meaning that of all of the kinds of things that a country could trade in, namely goods and services on the one hand, financial assets on the other, the overall trade in those categories of things has to balance. So, in other words, the exports of a country's goods, services, and financial assets have to balance the imports of goods, services, and financial assets. And how does that happen? Well, this is our mission for next week. We'll see that in chapter 16, we're going to assert that it is the workings of the foreign exchange market that ensure that there is a balance between exports and imports of goods, services, and financial assets. So, in other words, we view the exchange rate as being the price that ensures that this balance is held. What I want to do at this point, though, is to rewrite this notion that I have up here in this fashion. So what I want to do is say, well, okay, so if all of our exports and all of our imports have to balance, then it's got to be the case if we rewrite this that our exports of goods and services minus our imports of goods and services. So I'm going to take this and go over there, and I'm going to take this and come over here. Our exports of goods and services minus our imports of goods and services have to be equal to the imports of financial assets minus the exports of financial assets. Well, now we're in kind of fun, familiar territory because exports of goods and services minus imports of goods and services is net exports. And what I am asserting right now, although we've already seen this to be true, is that imports of financial assets minus exports of financial assets is the negative of net capital inflows. How do I know that? I will leave it to you to go back to slides 8 and 9 and the handwritten stuff that I had a few moments ago. But if we think about what are net capital inflows is the difference between capital inflows and capital outflows. So again, if we want to think about this, it's money flowing in and money flowing out. And money flowing in is coming about because we are exporting financial assets, or the domestic economy is exporting financial assets. So in fact, let me do this. Money flowing in and money flowing out. And by in, I'm not going to write this, but it's into the domestic economy and out of the domestic economy. Why would money be flowing into the domestic economy? It's exactly because the domestic economy is exporting IOUs, or promises to pay, to the rest of the world, stocks, bonds, however you want to think about this. And why are there financial capital outflows? Why are there dollars flowing out? There are dollars flowing out because there are people in the US, or economic agents more generally in the US, that are importing financial assets from the rest of the world. Again, stocks, bonds, whatever you want to say. So what do we have up here? We have imports minus exports. Here we have exports minus imports as our measure of net capital inflows. And so that's why we have the minus sign there. So we know that from a numerical standpoint, if net exports were 50, if we had a trade surplus of 50, then net capital inflows would be minus 50. Now, I want to say very quickly and as an aside, this is close but not real life. If you read chapter 16, which again, let me say, you're not required to do, you'll see that there's a broader measure of trade that is known as the current account balance. And the current account balance and this notion of net capital inflows, this would be essentially truth for those. But for most countries, the current account balance and net exports are behaving similarly. So they're different numerical magnitudes, but behaving similarly. So if our question is more what's happening to trends, then this is going to be sufficient. So that's kind of my aside. For our purposes, we're going to say this is our relationship that we're going to take as truth with, as I said, kind of a wink and a nod. So, goal number one, link net capital inflows and net exports. Net exports is the negative of net capital inflows. And why is that? It's turning on this issue that exports of everything have to balance imports of everything. Now, if you notice, we're going to bounce from slide 14 to slide 17. Woo, what happened there? Slides 15 and 16 are hidden, obviously, from this presentation, but available to you. They are different ways of trying to say exactly the same thing. So from my point of view, I thought that slide 14 said it as clearly as I could possibly say it, but I know that the words that I think of as being logical, especially in this context, may not be the best choice of words for you. So if you find that already your head is exploding, you may want to stop for a second, look at the hidden slides, see if that makes sense, and then come back to this. But what I want to do at this point is move on to goal number 2. And goal number 2 is an easy one. We can accomplish this very quickly, and that is to link real interest rates and net exports. Why do I want to do that? I want to do that because we're going to use this in chapter 18. We'll use it maybe a little next week when we talk about chapter 16, but in 2 weeks, we're going to use this as foundational for developing the model of the macroeconomy in the short run. So what do we know? We know 2 things. We know from slides 10 through 11 that there's a positive relationship between the real interest rate and net capital inflows. Namely, when the real interest rate rises in the domestic economy relative to that in the rest of the world, so implied here is an increase in the real interest rate in the domestic economy relative to the real interest rate in the rest of the world, then the quantity of net capital inflows goes up. And similarly, if there's a decrease in the domestic real interest rate relative to that in the rest of the world. We just saw that there's that net capital inflows is the negative of net exports. And so if there's a positive relationship between the real interest rate and net capital inflows, there has to be a negative relationship or an inverse relationship between the real interest rate and net exports. And as I said, we're going to see this with a stretch in the chapter 16 material, and it'll be our starting point for thinking about the development of the model in the chapter 18 material. Goal number 3 to facilitate our discussion in the next set of notes is to link the idea of net capital inflows to the broader concept of savings. And so, again, what I want to think about is net, by definition, net capital inflows is notationally this K sub KI. And so what is this first term? Financial capital inflows to the domestic economy from the rest of the world. If it helps, you can think about money coming in to the domestic economy And what's going out? Some sort of a financial asset. The country is exporting a financial asset like a bond, and bonds are going out. And if we have financial capital outflows, that means money is going out from the domestic economy, and financial assets from the rest of the world are coming in, and bonds, again, from the rest of the world, or generically, any kind of financial asset from the rest of the world is coming in. So those are our definitions here, maybe a shorthand way of thinking about making those words a little bit less complicated. So again, if we have net capital inflows that are positive, financial capital is the correct terminology. If it helps, think about this as money. There is more money flowing into the domestic economy, or more financial capital flowing into the domestic economy from the rest of the world than is flowing out by definition from looking up here. So if the first term is bigger than the second term, then there we have it. And so what does that mean? If there's more money flowing into the domestic economy, then the domestic economy is on net a recipient of the world's savings. So on net, the rest of the world is saving in the domestic economy, and the domestic economy is a net borrower from the rest of the world. So what we're going to use this for later on is to think about the incorporating this into the overall level of savings that happens in an economy, and we'll see a taste of this coming up in the next set of slides, but then in a big way in the next set of notes. And so our last goal with this set of notes is to ask the question, are trade deficits bad? So what's the wind up to? The wind up is to the question, are trade deficits, in a pejorative sense, bad? So in order to get at this, we're gonna adopt a framework that is consistent between this set of notes and the next one, and we're going to abstract from the effect of the business cycle on savings and investments and trade flows and so forth. So in other words, we're going to hold the level of gross domestic product or income fixed, and fixed at what level? The potential level of gross domestic product. So we're going to presume in what we have here that we have full employment. And this is how we think about analyzing the macroeconomy in the long run. Our starting point is, let's suppose we have full employment, and we ask questions like, what's the interest rate? What kinds of things are going to contribute to long run growth, and so forth. So this is our first taste of this. What do we know has to be true? Well, we know from our circular flow description that we could think about gross domestic product. So Y is gross domestic product, is the sum of the various spending categories in the macroeconomy. So consumption, investment, gross private domestic investment, government expenditures, and net exports. That should be something that you feel comfortable with at this point. Let's rewrite this. We can rewrite this as follows. We're going to take the net exports to the left-hand side of the equation and bring effectively Y to the right-hand side of the equation, or however you want to think about this. But we have net exports is equal to Y minus C minus I minus G. Let's do a fun trick, and that fun trick is to subtract and add taxes. So we're keeping the equality intact, but we are incorporating this other variable. And what do we have? If you think back to our consumption notes, we said savings at the personal level is what? After tax income, right? Y minus T minus C. And that's what we have in the first set of parentheses, personal savings. What is in the second? This is revenue that the government collects. This is spending. So for now, we'll just abstract from interest on the national debt, but we can incorporate into the T transfer payments if we wanted, or subsidies, whatever. So the T is going to tell us something about revenue, G is going to tell us about spending, and just like any economic entity, what is left over by comparing the income to the spending is our definition of savings. So this is government savings, and the I doesn't change. And we can take these two things together and combine them into savings at the national level. So we have an equation. Savings at the national level minus investment is equal to net exports. Big whoop. So let me show you a picture first. Now let me say again, we're gonna jump from slide 20 to slide 22, and that's because the hidden slide is actually better data than what I pulled here. But I was lazy last night and wanted to just get these slides posted, or yesterday afternoon, just wanted to get these slides posted. So what I have is expressing net exports and savings minus investment as a percent of GDP. So it just makes the picture look a little bit a little bit better. So this is almost, but not quite, national savings minus gross private domestic investment as a fraction of GDP. And of course, this is net exports. So why are they not exactly equal? Well, they're not exactly equal because of my aside from earlier. So one aside was that net exports properly isn't the measure of trade we should be looking at, but it's good enough. And additionally, I want to just own it. This isn't the correct definition of savings and investment, but I was too lazy to construct something better. The point of this is to show you some trends. So what do we observe? We observe that when, say, let's look at this time period. When we see a downward trend in savings compared to investment, we see an erosion of the net exports. So again, our equation here is that net exports is equal to national savings minus gross private domestic investment, where this is savings by roughly households, so personal savings, oops, and this is government savings. So we're adding those two things. We observe that when this balance is declining over here, then so too is there an erosion in the trade position. When we see, for instance, in recession periods, interestingly, what happens in a recession, right? We tend to see more saving on the part of households in particular. So in a recession, we see less consumption, more savings. So higher savings at the personal level for sure. Less investment by firms because prospects are dim. And so that contributes to this upward tick. And we see as well, going along with that, an improvement in the overall trade position. So it's not implausible to believe that this relationship has to hold. But our bigger task at this point is to think about this question of, are trade deficits bad? So there are several issues that one could bring to bear here. So one of the issues is a question of default. So if we have a trade deficit, right? So if we have persistent trade deficits, then that means we're borrowing, right? We have so if we have trade deficits, if net exports are less than zero, then that implies that net capital inflows are greater than zero. And what does that mean? That we are borrowing from the rest of the world. We're exporting more financial assets to the rest of the world, and money is flowing in than we are buying from the rest of the world. And so we are becoming increasingly indebted. So, one question that can emerge in this context is, can we default? Um, Certainly, in the royal we sense, the answer is yes. And there are plenty of instances, and some of you may be studying countries that have experienced currency crises or out and out defaults on sovereign debt. The US is a little bit different in, blessedly, in the sense that the dollar is one of, if not the, international reserve currency, which we may have a little bit of opportunity to talk about in the next set of notes, two sets of notes ahead. Additionally, unlike many countries, the US is able to denominate its debt in terms of its own currency, and it controls its currency. It's not tied to anything. And so while there could be other macroeconomic problems, namely inflation and other kinds of things, if it were the case that everybody came calling to the US and said, we want you to pay off your debt, the US could do it just by printing more money. So the issue of default for a country like the United States is not as pressing, if at all, an issue compared to particularly developing economies. And so this may be something, as I said, that comes up. In your own analyses of the countries that you select. An additional question is, let's see if I can spell it while I talk, sovereignty. If the United States or any other country that has persistent trade deficits and has to borrow more and more and more, does it lose some of its political sovereignty? Meaning, if it owes increasingly large amounts or just flat out large amounts to other countries, does it have to pay attention to those other countries' needs and wishes in its own political decisions? Again, for some countries, yes. For a country that is as big and we'll just say as big as the United States, that's not as pressing a concern. So these issues of default and issues of sovereignty are certainly things that are relevant, but maybe not for a country like the United States. So is there a sense in which trade deficits are bad on other margins? Maybe, and that's the kicker right now, is that all that we can say from a positive economic point of view is, if net exports are negative, then national savings is less than gross private domestic investment. So the question that is deeper and more important to ask is, why is national savings less than the amount of investment expenditures that the economy wants to undertake? That's the question. Rather than focusing on this good bad thing, is why this? And we have two possible reasons. So one reason why is we're poor savers, or the country in question is poor savers. So you're living beyond your means, you're behaving in a profligate fashion. In that particular case, taking on more and more and more debt is not good. And we could say, yep, that's bad. So, it would be in the old days, like when I was your age, I for my college loans, I got a check that was given to me, either, I can't remember because I am old, either for the whole academic year or for the semester, but it didn't matter. From my point of view, it was just a colossally large amount of money. And they just handed me the check. It didn't go to the university. It was my obligation to kind of walk that over to the bursar's office. So there was that little moment of temptation where it was like, wow, I could have a really fun party, kegger on me. I shouldn't say that out loud, but that is the way I am. And so, that would have been a situation in which I would have had borrowed but lived beyond my means. I would have flunked out of college and not been the fabulous successful the success that I am now. And in other words, not been able to repay my loans. But on the other hand, it could be the case that a trade deficit can reflect really valuable investments. So the economy has very, very high levels, lots of investment projects that are going to be profitable, and it just can't save enough for them. I mean, the flip side of this is that we tend to have this knee jerk reaction that net exports being positive, a trade surplus is good. But what does that mean? That means that national savings is bigger than gross private domestic investment. So, in this same spirit of this argument, we could say, well, why is that the case? Is it because there aren't any good investment opportunities in that particular country? That the prospects are just so poor that savings has to flow someplace else. So, the really, really important thing out of this slide and the preceding that I want you to understand is that we can't attach this pejorative statement to the observation that we have a trade deficit or a trade surplus. All we can do is make the positive observation that we know something about the balance between the domestic economy savings and the amount of gross private domestic investment. And if we really wanted to make a pejorative statement about the size of the trade deficit, we totally have to dig deeper into what's happening at a more disaggregated level to national savings and gross private domestic investment. And so, with that, what I want to do is think about what are the big takeaways, because I think, as I said, this is a really confusing. So, let's see if I can, maybe I can't do it the way I wanted to. We'll do it this way. What are the big takeaways? Because I think this is a confusing set of notes. One of the big takeaways that I think you should practice with and try to get as comfortable with as you can is the definition of and interpretation of net capital inflows. And I'll be honest, I don't know of any way to do it than to write it out, to look at it, to play around with some numbers, to think about it, leave it alone for a few days, and come back to it. At least for me, that's the only way that I've been able to kind of get a handle on it. You should know that if there is an increase in relative real interest rates in the domestic economy, again, relative to those in the rest of the world, that there's going to be an increase in the quantity of net capital inflows. And by extension, that there will be and a decrease in the quantity of net exports. And why is that? It is because, sort of other big idea, is that if we think about net exports, they are the mirror image of net capital inflows. So if a country has a trade deficit, in other words, so if net exports are less than zero, then we have to pay for that by exporting financial assets. Pay for the imbalance between exports and imports, so pay for the trade deficit by on net exporting financial assets. And net capital inflows are positive. Similarly, if net exports are positive, then the country has funds available to lend to the rest of the world, and it can be importing financial assets. And then the final kind of big idea is one that's more relevant for life. So literally, after the last presidential debate, my daughter called me and said, "Oh my gosh, my roommates were talking about trade deficits and blah, blah, blah. And I was so happy I was an econ major because I could talk about this." And I'm like, oh, what a nerd. But all we can say, so positive analysis says that if so all we can do is say that if net exports are negative, then it is the case that um, oops, national savings minus gross private domestic investment is also negative. We can't say anything further about the trade deficit being good or bad or indifferent without knowing something at a more disaggregated level. And indeed, there are different times and different places in U.S. history where trade deficits have been attributed to bad circumstances, and on the alternative, trade deficits being viewed as being not problematic. So these are the big takeaways. I know that this stuff is hard. I'm going to hope that if you have questions, you follow up with me and or with a TA, and I'll try and have a few practice problems to help with it. Take care.